Hey everybody, it's Jonathan. So I just finished a class with my Premier members and we talked about our approach into earnings. It's a great approach, an approach I've been using for 8 years. It's consistent, reliable. I think you'll find it makes sense. Any questions, comments, leave something in the comments. I'll get back to everybody. And if you wouldn't mind, like, subscribe. It really helps. Enjoy. So every single earnings trade I make during earnings season uses this exact approach. Every single time. So what I do is I backtest every single name to see exactly when they released earnings and how much they moved after they released earnings. So looking at HZO, I have the last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 13 releases of earnings. The max move is the max percentage that the name moved in its last earnings. So if HZO reported after the close on January 24th, on January 25th, the max move up or down was 18.15%. The final move at the end of the day was 15, and this was 23 days until expiration. So January 24th was 23 days until the February expiration. So if we look at the last earnings moves, that's what we see. Okay? Does everybody understand this so far? Any questions? I didn't find HZO and then backtest. I wanted to look at the entire universe, and then I wanted to see what stocks move more than their options or pricing. So if we have all this data about HZO, what do you think is a fair estimate or a fair over under for how much HZO is going to move in its next earnings release? So the last one, it moved 18%. The time before, 29%. Time before was down 27%. If you had to bet $1, say, and what's the number that you would say HZO would, be above or below? Okay, come on, participate, guys. I want you to learn this. This is important. Okay, mid-teens, we got 14, we got 18, right? If we take the average of the last 5 or 6 or average of them all, it's probably about 15, right? 12. Okay, so Steve says 12, but the only time that it's moved less than 12 is here. Okay. A couple of times it's moved less than 12, but they're really close, right? So if we're talking about an over-under, I would say over 12. That seems really low to me, especially if we take the average of the last 3, it's about 22. Tom says it's due for a smaller move. Tom, that's hogwash. It's not due for anything. This stock doesn't have any memory, buddy. This stock does not remember how much it moved. Why does a stock like HZO move this much after earnings? Why do you think? Does Apple move 20% after earnings? Probably not, right? Ed, exactly. Ed, great answer. It's hard to value. Nobody knows about HZO. They don't have the analysts that we talk about. They don't have all the market makers. They probably have some, sure. But the reason it's so darn volatile is because people don't know where it's valued at. Couple that with the amount of volatility that's in the market right now, VIX over 20, I think, for me, it's fair to assume that 16 might be a good over-under, okay? So if I'm going to make that assumption of 16, therefore, when HCO has their earnings, and HCO has their earnings, we don't know exactly yet because it's just an estimate, but the estimate is going to be for April 26th, okay? HCO 26 estimate. It'll be right around there, but it's not 100% that date. So if we think on the next earnings date that HCO is going to move 16% on that one day, okay, so we have 16% for earnings, fine. But now I ask you, if we go out to May, because we want to be in May, because that's when the earnings are going to be, if one day is valued at 16%, what do you want to value the other 38 days at? The other 37 days, right? Earnings is just one day. Okay, Mike, I'm going to answer your question in a little bit. That's going a little ahead. I do want to share with everybody's. Okay, so if we think HCO is 16% for earnings, it also has 37 days. Right now in April, there's no earnings, right? And right now it's about 10%, $1.68, about 9%. So right now the market's factoring in, what's that, like 8 cents a day, 9 cents a day. So what happens if we factored in 5 cents a day for 37 days? 37 times 5 would be, what's that, 150, 185. That's about 10%. So if we say 16% for earnings and 10% for 37 days, that would mean that right now, if we're happy with that valuation, the May straddle should be trading at 26%. Let's give it 5% for 37 days, which is nothing, right? If that was a 5% straddle, that would be stupid cheap. That's 21%. Am I confusing you? Do you understand this? Do you understand how I'm backing into a valuation? Okay, can someone tell me that they understand besides Steve? So far, so good. Okay, good. Excellent, guys. Awesome. Awesome. So I'm going to show you 16%. All I did was we just took an average of the last moves. Oh, Ron, good. Good, good, good. I'll make sure I send that out to everybody too. Okay? So 16% is just, I just took an average, ballpark. The 5% for 37 days, I just took, hey, this is 10 days, there's no earnings. The straddle is $1.70, or the vol's high, $1.70. That's like 9% of the overall price. 10 days, it's like 20 cents a day, actually. I'm only giving it 5 cents a day. So one day is 16% in May. The other 37 days We valued at 5% movement. Add these together. This straddle should be about 21%, conservatively. Right now, this straddle is so unbelievably, ridiculously stupid, inexpensively cheap. So cheap. Ridiculously cheap. Okay? Yeah. Good. Yeah. So if we look at this now, 1850, if you look at the 20 calls and the 17 and a half puts, you can buy these both for, $1.90. It's a phenomenal trade. It makes so much sense. And when you're looking at earnings opportunities, whenever you risk your money, this is the analysis that you need to go through. And I do this for every single trade that I make during earnings season. I would never trade an earnings name without doing this. Okay? Some people might think of earnings crush. Earnings crush is a marketing term. Don't get caught up that all stocks their vol goes higher into earnings and lower after earnings. It's not true. If that was true, we should all stop what we were doing, raise $1 trillion, and buy straddles going into earnings and cover the day before earnings. We'd be, we're Warren Buffett. It's not true. These markets are somewhat efficient. We need to do this kind of analysis to see where we can find value. For smaller accounts, you can do the 22s and the 15s.